What's going on, y'all? Hope all is well. Another wonderful episode of Convos with your CFP, Mario Payne, in beautiful Florida. Before we get started, as always, like, subscribe, share our channel. Great information. Your CFP, man, I've been practicing for 16 years, a CFP for 11 years, have our own ETF for the stock market, Let Be, LETB as in boy, the first black-owned AI-powered ETF ever on the market. And of course, we have our investment app, Let Bob, LETBOB. Check us out. But today, we want to go over what's going on and how Mr. Fed Chair himself, Jerome Powell, was like, "Skirt! Pump the brakes." 8 days ago, 1, 2, 3, 4, 5, 6, 7, 8 days ago, not 8 months. 8 days ago, he was like, you know what? We don't see ourselves pausing rates. We're probably going to continue. But then what happened? A couple days ago in my old video, as you guys can definitely check us out on our YouTube page and see, inflation is cooling. Inflation is going down at a 2-year low. Now, we're not where we want to be, but definitely it is at 4.9%. It was as high as 9% 9 months ago. So it is going down. So the Fed raising rates, killing the stock market, has helped. Has it helped investors? Has not helped the individual who got laid off, and we do not want to see anybody getting laid off, but raising rates have helped. So he paused. But let's see what he said 8 days ago.
Today, our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today.
Y'all heard Mr. Powell, not today. Now let's see why people today are saying what Jerome Powell said 8 days ago is not the case. Anytime you want to check out interest rates, it's always best to look at the bond market. The bond market usually is a prediction of what's going to happen to the stock market, especially high yield bond, which we'll talk about. The bond market expecting there's no more raises, and there's actually going to be a cut toward the latter part of the year. And Mr. Powell ain't say nothing about that. As you can see, it is a 91.7% chance, not 100, but a 91.7% chance that rates will stay the same, because right now rates are in between 5 to 5.25%. The right-hand side, you can see no change, 91.7%. 91.7%. 8% chance of a hike. Ain't gonna happen though, right? He said leaning towards it, went from leaning towards it 8 days ago to now an 8% chance of a hike. It ain't gonna be no hike, y'all. It will not be a hike. Easing it right now, 0%. So it shows that as things stand right now today, the Fed's gonna pause raising rates. Pausing raising rates means that companies won't have to worry about more money out their pocket when they get a loan from the federal government. Companies will be able to borrow more, not have to pay as much interest rate. That's good. But then things get better. That's in June. Look at that, y'all. Look at that. That means that rates are going down. When rates start going down, what happens to the stock market? Pew, pew, pew. It starts going up, which is great for investors. Great for investors. But it doesn't stop. Let's look at September. 31%, 4.5. 4.75 is almost 50%. So the bond market, CME Group, bond market, they're predicting that not only will we probably decrease in July, but it's a 30% chance we're going to decrease even more, like a ladder. Last year, it was going up. Now that ladder's going down. And when it goes down, then the stock market is going to go up. In November, because they take a break in October, 48.6%, they have 4.5%. And then again, 31% at 4.25. So that ladder stepping down. So we understand that. All right, Mr. CFP, Mr. Painful Profits, we understand that. We understand the market's going to go up. How can we take advantage of it? Well, even if you're a more conservative investor and you want to invest in something that is going to grow, but at the same time, you're conservative with the growth, look at here. So let's look at Charles Schwab. Charles Schwab asked, what happens to bonds where interest rates rise? It's highlighted. Most bonds and interest rates have an inverse relationship. Inverse relationship, profiteers, means that it's changed. One goes up, one goes down. That up, down, down, up, like a levee, right? Seesaw, seesaw. When rates go up, bond prices typically go down. So interest rates were going up, bond prices was going down. The market was going down. That's why last year, bonds went down. Historically, when the market goes up, bonds go down. When the market goes down, bonds go up. But last year, bonds went down as well because interest rates went up. And it doesn't happen like it happened last year. And when interest rates decline, bond prices typically rise. Fundamental principle of bond investing, which leaves investors exposed to interest rate risk. And that is the risk that an investor's value will fluctuate due to changes in interest rates. That's risk. And how do we slow down or stop risk altogether? Diversification. That's why we don't want to have everything in bonds, everything in stocks either. You're diversified, right? We are diversified. How do we become diversified when it comes to bond risk? Well, we know that interest rates are going down. Want to be more conservative? This is what we do. Boom! J and K. Now, as a certified financial planner, not telling you what to do. I tell my 1,000+ clients what to do, of course, because I have a fiduciary responsibility. But to the world, I'm not telling you guys what to do, but I am showing you information that could help. As we can see, we have 2020, boom, right? Look at that. Look what happened in 2020. The value of this went down. And this is high yield. High yield are bonds. So again, when interest rates go up, bonds go down, right? And as we can see, we had COVID. Everything went down with COVID. But as interest rates went to zero, what happened? It went up. And then, of course, the Fed started raising rates last year. When the Fed raised rates, what happened to bonds? It went down from 109 all the way down to 87. Now, from 89 to 110, that's some growth. That's 25%. For a bond to make you 25% return on your money, that usually is like 8-9 years because bonds don't make that much money. You heard my voice? I screeched. That's how much I was surprised that a bond would make 25%. It does not happen. It might take you 6, 7, 8 years to make 25% from a bond price. You make money on bonds because of interest. They pay you interest, not because of the price appreciation, but due to interest rates going up so quickly, as you can see, bonds went down. So as an investor, might be time to look into high yield bonds because they're down. And we know from a probability standpoint, interest rates will not be risen. Go back to June for me, please. 91% chance it stays the same. And then in July, 80% chance it stays the same. 45% chance it goes down. And then in September, down. November, down. December, down, right? So interest rates are going down at the end of the year. Jerome Powell saying one thing, but in actuality, what's being predicted by the powers that be is saying another. Nothing against a politician, but I always say, watch what they do, not what they say. So profiteers, for today, when interest rates go up, bond prices go down. Inverse, like a seesaw. And we saw last year, interest rates went up, bond prices went down. So now, since interest rates will be going down, those bond prices will go up. So you want to look into high yield debt or bonds in particular for growth because right now they're down. J and K, TLT. We look into those investments. They're lower risk than a stock. Hope that helps, man. I'm all about education. Health is wealth, mentally and physically. Let's make some painful promises together, y'all. Peace. My voice is gone.
And you just wanna get paid, tired of making the money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making the money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Bitch at the check, you know, and it could be different, you know.